Derek Jones, Director of EOS Property Group. Welcome to our next educational video, if you like, and this one's titled Roadmap to Your Future. Previously we had a webinar which was called Roadmap to Successful Property Investing in the New Age World, if you like, and that's also available on our YouTube channel. Now this one tonight, or this afternoon, whenever you happen to be watching it, is very much about how you can develop some sort of strategy, if you like, a plan that will allow you to stop work in accordance with what you're aiming to achieve. So, roadmap to your future. Welcome, and let's get on with it. Okay, so what we're going to go through is as follows, is the notion of, first of all, why do anything? And let's be honest, there will be some people who are listening to this video who are very much looking at it from a retirement strategy. Equally, there will be those that are looking at property and some sort of strategy, if you like, to leave the workforce earlier than is typically the norm. So that's one thing. The second thing is we'll get you to do a bit of number crunching and how much money is enough. So in other words, what do you need when you stop work? Then we're going to ask some questions about you, your plans for your property portfolio, your stop work strategy, and whether in fact there's a connection between the two. So that's something for you to think about as well. Then we'll obviously go through some property stats for you, and then my co-director Chris Granary will come through and look at some of the various scenarios that you may like to consider in terms of looking at your stop work strategy. So let's have a look at that. Look, it's with some reluctance that I put these figures up, because some people may see this, we're using these as an alarmist type thing, and then to make you, actively encourage you to go and buy a property. Far from it. Can I just get that off the table straight away? This is very much about just giving you some information that you may not be aware of. All right. And having worked with a couple that are very close to me who are on the couple's age pension, $31,500 per annum, just as of April 2013, it is very difficult to live comfortably on that sum of money, and I can assure you it's a hard road to hoe, and therefore I would actively encourage you to do anything possible to make sure that you've got some supplementary resources as a minimum to offset the effects of the pension. So that's what we're on about. Now, before we go much further, I need to put it on the table that, look, I don't have any financial planners qualifications, and the information that I'm sharing with you today has been distilled from various sources across the net. It's all out there, and if you don't believe me, just go searching and find it for yourself. So the first question that you've really got to ask yourself is, well, how much do you need? Now, one of the ways you could tackle that is just to throw some darts at a dartboard and come up with some random number that's not going to mean anything whatsoever. Sure, it'll give you a number, but does it have any relevance to you and your situation? And the answer would be no. So we need to approach it a little bit more scientifically. So go and grab a calculator, piece of pen if you like, put this video on pause, it's up to you, and let's work through a process whereby you can work out what it is that you're going to need to survive on or to live on. First of all, you need to prepare a budget. Now, I know this may sound a little bit awesome, but the bottom line is that you're going to be stopping work at some stage in the future, and you need to make sure that your ducks have lined up. So let's grab those calculators and let's do a little bit of an exercise. The first thing you need to do is how much you're currently spending on your non-discretionary items. Now, what do we mean by non-discretionary items? Well, it's things like your mortgage, it's things like your utilities, power, phone, gas, those sorts of things. It's things like any educational expenses you may currently be incurring, any costs that you are incurring raising your kids, and it's the day-to-day stuff. It's the food and groceries, the petrol, that sort of stuff. The stuff that you just got to have, insurances, those sorts of stuff. The next thing that you need to itemize is to look at your discretionary costs. And they're the sort of things that you can, they sort of define your life, if you like. So they're the restaurant meals out, they're the holiday trips, that's the a couple of bottles of wine per week or whatever it happens to be for you. It's the entertainment stuff. It's those sorts of things that, for want of a better description, maybe add quality to your life, if that's in fact that important to you. So once you know how much you're currently spending, then you're in a pretty good position to start establishing and working out what you're going to need when you in fact stop work. The next thing that we can do is we can go and put a line through the items that will no longer be part and parcel of your financial situation when you stop work. For example, it could be that the kids have all left home, they're now independent, and there are no more educational expenses incurred for them. So you put a line through that. It could be that your house is fully paid off. Mind you, I might add that not a lot of people will be that fortunate in today's day and age, but let's assume that your house is fully paid off, so let's put a line through that figure as well. So go through and analyse all of the things that you're currently spending your money on and put a line through the ones that will no longer be part of your financial situation when you stop work. The third step is that obviously as you stop work, there will be other expenses that come into play. For example, it may well be that you have plans to do a round the world cruise every year. Well, how much is that going to cost you? That gets added into your new financial picture. It could be, well, it's highly likely that we're all going to need to have some extra dollars put aside for additional medical expenses. So we need to put that aside as well. So that now we're starting to build up a very comprehensive picture of you and your financial situation. The last thing that we need to do is we need to allow for inflation. So look, in recent years, inflation is probably running at about 3%, sure, just under, but let's use 3% as an idea. Add up all of the net result of steps 1, 2 and 3. Multiply it by the number of years that you expect to be retired, and then an add inflation factor of say 3, 5, whatever it is, percent that you think is relevant to you and your situation. Now that seems a fairly complex sort of process, and for some people it may be a little bit challenging. Now if you're one of those people who just puts everything on the credit card, every dollar out the door, then an easier strategy may be just to go back through all of those last year's credit card statements to work out what it is in fact you spend. Having said all of that, we need to be financially savvy. So it's important that you do take time to do this, because it's going to set you up or help set you up for when you do in fact stop work. So that's one way. The other way we could do it, and this is far simpler I might add, but probably not as reliable, but it's a ballpark figure for you to work with, is to look at what you're currently earning, you and your partner, if in fact you have a partner, and then multiply that by 75%, because there is a lot of literature out there that suggests that is what people want. You know, if they're currently earning $100,000 per annum gross, that they'd like to live on about 75. Okay, so there you go. So that's another way, a simpler way, but possibly not quite as accurate. But anyway, it's a method. The other one you could look at is, well, the Westpac do a lot of work on this for us and have done for a number of years now. It's called the Westpac ASFA standard. And Westpac go through typical expenditure patterns of a normal person. Now they look at all the ins and all the outs, and they've come up with these numbers. So if you want a basic lifestyle, you're going to need about, and I'm looking at couples here because those of you who are single, all you've got to do is just raise your eyes a little bit. But for a couple, $31,500 will give you a very, very basic lifestyle. Now, coincidentally, that is the figure that age pensions are currently set at. So there you go, that gives you an idea. A modest lifestyle, about 32.5, so it's only fractionally above that. But a comfortable lifestyle is about 56.5. So it steps up a little bit to be comfortable. All right. So that is another number that you could possibly work from when you're going through this process. Now I might add, just if we digress a little bit, that 2007, Average superannuation balances for that 55 to 64-year-old group was about $142,000. The median group was about $56,000. So as you can see, that people in that age category certainly don't have a huge superannuation nest egg by and large, which is interesting given that super's now been around for about 23, 25 years, something like that. So an interesting just little sideline there. So once you've worked out your figure, if we now go to the bottom of our screen here, we're just going to use Westpac numbers, all right? Because that seems to be reasonable in the context of things. So here we are, we're a couple and we want to be comfortable. And we've just retired, so we're in that 65 age group, or stop work, 65. Now, typically most of us will fall off the perch at about 88. So if that's your lifestyle, that's your want, and you want to be comfortable, you're going to need to have just over $1 million in assets set aside that are growing at 5% per annum. All right. Now, if you're one of those people who've been able to structure things very well and you're still able to qualify for part of the pension, you're still going to need a minimum of $500,000 and a bit, upscaling up to just over $1 million. So there you go. That gives you an idea of the sort of target figures you might want to have when you're looking at your current situation. If you're single and you want to be comfortable, 41 grand a year, you're going to need a nest egg of about 770 if it's in fact growing by 5% per annum. If you've structured things fairly well and you're eligible for part pension, you're going to need at least 475. So that's if your nest egg is growing at 5% per annum. If we step it up a little bit and we've got that nest egg now growing at 7% per annum, the same scenarios, you only need now 865 only, which is 150 less than if it was only growing at 5% per annum. And similarly down here, 635 if it was growing at 7%, which is 130 odd less than the 5% growth rate. And once again, it's possible that you may be able to do the part pension thing if you've organised your assets very, very well. So the question then becomes, well, okay, if they're the numbers that I'm working to, how am I going to get it? And look, there are a range of options. Now, I've got to be honest with you that many of these are the domain of a financial planner. So if you want to talk to them about those sort of things, go and see someone who's fully licensed and accredited to do that for you. But I'll put these on the table because you might be somebody who likes tinkering with numbers and pieces of paper and things like that. So the obvious one is cash. Maybe you're one of those people who has built up a large cash nest egg. And believe me, there are people around. In fact, I know a couple in my immediate circle who built a cash nest egg throughout their working life. So that's one option. The other option, of course, is the other asset of choice are shares or / managed funds. Maybe you've got a parcel of those in your background that you may be able to access come retirement. Superannuation, look, and it's an asset that most of us have, albeit that we have it at various degrees and size. So have a look at your super balances, and so that's one thing. The option of part-time work. Now it seems a bit silly, doesn't it, really, when you start talking about a stop work strategy and then we throw part-time work back at you. But consider this. At the moment you're probably working, say, 8 till 5, by the time 8 till 6, by the time you jump in the car and go to work and come home again and that sort of stuff. So a large chunk of your day-to-day living is being consumed by this thing called work. Now, if you suddenly stop work, all of a sudden you've got this massive gap in your life. Now, for some people, that can be a little bit daunting, and they may feel quite comfortable or willing to, instead of working 5 days a week or 6 days a week, depending on what their current roster is, they may be happy to do 1 or 2 days a week, just to pay the groceries money sort of stuff. But that may well be an option, because not only are there the financial requirements for a healthy stop work phase of your life, there's also the emotional, social side of things as well. So it's not just a financial situation you need to consider. Obviously, some of you may be in business and your intent is to actually sell it, and that provides you with some sort of nest egg. Look, I don't know what business you're in, but what's the going rate for a business like yours? Is that going to provide you with sufficient nest egg? I don't know. Something to think about. But given that we are a property group, we also need to talk primarily about property. So that's what we will do. Let's move on. So let's just go back a couple of slides, and we talked about assets growing by say 5 and 7%, and then let's look at how property has performed, particularly here in Perth in Western Australia. Since 1980, the property prices have increased by about 7.7% per annum, so it's the period 1980 to 2013. In the period 1990 to 2013, 7.2% per annum. Then 2000 to 2013, 9.8% per annum. And then since 2010, property prices have done nothing. In fact, they did drop back a little bit, but they've now come back to where they were 3 or 4 years ago. But that's a normal part of the cycle. Now, talking of cycles, let's now look at 3 stages of property investing. So remember, we're talking about gathering assets for our stop work phase of life. The first phase, quite clearly, is the accumulation phase. That's the phase at which you're purchasing your properties, you're adding value to them, that sort of stuff. So it's the accumulation phase. Now that tends to need to be done relatively quickly without being silly about it, because the sooner you can gather your nest egg together, the longer it's got to grow. And that in fact is the second phase, or the second stage. It's the consolidation phase. That's the phase where you're maintaining your properties, you're allowing them to grow, you're allowing your rental income to increase, you're paying the bills, new carpets, keeping them up shipshape so that they are maximising their returns back to you. And the third phase is that stop work phase. And that is when you start to realise the property assets or the other assets that you've got as part and parcel of your nest egg. So that's the stop work phase, and when you start to sell off or live off the rental income that you've been building over those previous 2 phases of property investing. So the next question we need to ask ourselves, and for some people this may be something that they haven't considered, is does your property strategy meet your goals? Now, what do we mean by that? For example, if your goal, if you like, in terms of being ready for that stop work phase of life is to have a big nest egg, to sell the lot, put all the money in the bank, and then draw it out as you need it, your goal is to build a larger nest egg as possible. In which case, your primary strategy should be largely revolving around capital growth. Okay, so you should be choosing properties in capital cities with good growth prospects, rock solid blue chip type locations. Now, there is another consideration, that is obviously you need to make sure that the rental returns are such that they do sustain your portfolio with minimal, if any, input from yourself. So that's one strategy, is to grab something that goes up in value, sell it, put the money in the bank, and then live off that. So that's a capital growth type strategy, more suited for that sort of person. The second strategy is and you may be looking at just a drip effect with your money. In effect, you want just a little bit coming in every month, or enough for you to live on every month, so that pays the groceries and the bills and the round the world holiday, that sort of thing. So in that sort of person would be looking more at a cash flow strategy. In other words, you should be buying properties that have got an extremely high rent return because that's what you're going to live off. Now, obviously there are degrees of both of those, and the ideal scenario for you may be somewhere in the middle. So I'm not advocating it's an either or type thing. I think there's some middle ground that is ideal for each and every investor, and where your middle ground is best determined by you and your situation. And we're happy to talk to you about that if you like. So that's where we're up to. So now I'm going to hand over to Chris Granary, who's going to go through some scenarios for you. But before he does that, he's actually going to put some framework up there for you.
Thanks, Derek. Folks, I would like to talk now about some scenarios for retirement, or for at least stopping work. We all buy a property with the intention of producing sufficient income or wealth that we can do what we want to do with our days. Now, before I launch into that, I do need to speak a little bit about the armchair investor concept. The the idea of today's webinar is not actually to talk about the armchair stuff, but I do need to explain it very briefly to you because some of the comparisons in the future will use the armchair concept. So I understand many of you understand how the process works, but very briefly, the armchair developer concept is that each of the joint venture partners acts in capacity of developer and as a result can purchase a property for 20% below market value. Because you're purchasing well below market value, the normal rent return is that much higher by comparison, and often the armchair development projects are cash flow neutral, if not cash flow positive. And also the stamp duty is very, very minimal because it's only stamp duty on the land, and that's then divided up amongst the joint venture partners anyway. Whereas if you buy through a normal, you go to the shop and buy a normal property from a real estate agent, there'll be stamp duty upon the transfer, which can be, quite an expensive deal. Now, just to put that in a bit more accurate comparison, I've chosen one of our typical armchair development projects. This one's at 459 Charles Street in Perth. And if we just look at these comparisons, then we'll use these figures for the scenarios coming up in a few moments. So you can see that EOS for the property, the people using the armchair development concept will pay $400,000 for this 2-bedroom, 2-bathroom unit, whereas if you buy the unit normally off a real estate agent, it'll cost you $500,000. There's no stamp duty; it's all included within the $400,000. But of course, from an agent, the stamp duty around $25,000, perhaps not quite that much, but around $25,000. The final value on the product is the same. There's still 2-bedroom, 2-bathroom, 2-carport apartments. But of course, the equity position for the EOS investor is that much higher. They've paid $100,000 less than market value, so they've got $100,000 built in equity. And also, and the reverse is true for the normal investor who spent $500,000, but spent $525,000 because of the purchase costs, but the property's only worth $500,000. Now, there's nothing wrong with that. That's how we've all bought property in the past, I'm sure. You start off a little bit behind the 8 ball, and then capital growth finally clicks in, and you start to get ahead. And the cash flow system with the EOS is neutral, of course, and we estimate on about a $70,000 income with a property, this property in Charles Street, the average investor will be about $100 a week behind, and that will slowly improve as rents come up over the years. But that gives you a comparison. So given that scenario and using those properties as an example, let's just think through some potential. So let's imagine we bought 4 properties over the next 5 years, and they're all, those Charles Street properties, all valued at $500,000. Now, let's look at the portfolios in 10 years' time if you'd bought through a real estate agent or if you'd bought as an EOS project. And that's provided property prices rise by 7.2% per annum, as per Derek's information earlier on. That the rent returns have a net of about 4%. You'll get more than that as a rent, it'll be about 5%, but you'll lose some money because of a couple of weeks there's no tenants and there's fees and rates and management fees and those sort of things. So let's use 4% as net value, and let's guess interest rates that are averaging 6%. They've been well below that for the last couple of years, but they also are often above that. So on average we're using 6%. Then, if that was a scenario, then at the end of 10 years, those 4 properties that are worth $500,000, the portfolio would have grown to be $3.5 million. So if you sell the lot, just sell it, the EOS capital gain would be $1.9 million, whereas the normal investor his capital gain would be $1.4. So there's a significant difference in the overall portfolio. Now, that's ignoring capital gains tax at this stage, but we'll bring capital gains tax in a few moments. Now, if you wanted to just hold those properties and look at your rent returns, EOS rent return roughly $46,000 a year, normal rent return about $22,000. In that, you're still a little bit behind on the last couple of properties that you purchased because they haven't been owned for 10 full years if you're a normal investor. With the EOS ones, they're neutral. Typically, we found that a normal investment, buying through a real estate agent, in major capital cities, they're cash flow positive by about the 6th or 7th year. That's when they start to kick back and start to return some cash flow. So the key differences obviously are for armchair investors. There's an increased profit margin, there's higher weekly returns, that's obvious. And there's no shortfall at the beginning of the accumulation phase, meaning that because you buy this property cash flow neutral, you're not leaning into a line of credit you've got established. You're not, say, $3,000 or $4,000 a year out of pocket to hold the portfolio. And some people are using lines of credit to hold their portfolios. The debt starts to mount up. Also with this process, it allows you to accelerate your building your property portfolio. As you may well be aware, the tightening of the lending restrictions have made it harder and harder for people to increase their property portfolio. The banks want to see increased income. The banks want to see increased equity before they're prepared to lend you on the next property. Now, often that means for a normal investment, you buy the property, you've got to wait 4 or 5 or 6 years to get some capital growth to have increased equity, and maybe 4 or 5 years for the rents to increase sufficient that they're adding considerably to your income. Of course, with the EOS ones, that's not the case. Within 2 or 3 years, the rents are positive, or if not positive from the very beginning, and from day one, you've got this built-in equity, this 20% profit that you've made that exists as equity within the property. And finally, I think one of the big key differences is that built-in safety mechanism. If something happens down the track, you're able to sell the properties and there's no debt attached to them, in the sense of you haven't increased your debt in a way to hold the properties. For many of us in the past, we've built a property portfolio, set up lines of credit, and use the lines of credit to support the portfolio, hoping the capital growth would outweigh the increased expenditure in the lines of credit. And that may not have been the case over the last 4 years anyway. With the armchair ones, of course, there's no line of credit necessary. You don't need to increase your debt to hold the portfolio, so you can sell at any time and get back to a neutral position, if not some capital growth position. Well, there's always the equity growth in there as well. So let's build some scenarios. Let's imagine a portfolio and look at the possible options for us down the track. So let's say you bought a $500,000 property in 2013. You're able to buy another one in 2014, another one in 2015. You took a break and bought one in 2017. Now, I know in the olden days people would say buy a property with 10 properties in it or 7 properties in it and hold it for at least 10 years. Well, firstly, it's perhaps not possible nowadays. And the second thing is, do you need to be that large? What are your long-term plans? Do you need a very large property portfolio to meet those needs? So let's continue. We're imagining that you've paid $400,000 for them. They're worth $500,000, so it's a typical armchair investment. We'll stick to the capital growth of 7.2 and the rent percent is 4%. If you extrapolate those numbers forward, so you take a $500,000 property that grows at 7.2. You can see in 2014 it's worth 536, then 574, then 615, and then 660. Now, you and I both know that property doesn't grow nice and evenly, but you can't deny the statistics that show that property has been growing, averaging 7.2 over 30 years. Now, it does 10%, then 12%, then 3%. It's all over the place. But the averages are there. We've got to use some basis to project forward, so I'm just going to use these as numbers to work with. And you can certainly adjust your own thinking to suit whatever you think is a fair and reasonable capital growth rate. So, what about if you bought the properties and then you lived off rent for 10 years? Well, as we said, EOS rent's $46,000, normal rent $22,000. Not a lot of money, not a lot of money to live on, but I mean, it might add something to an existing superannuation fund or some other resources you have to fund your retirement, and it does give you a large property portfolio retained that grows in capital. What about this? Invest in an armchair development every second year and sell it. Don't do any of this long-term stuff. Just buy and sell. Buy it, take your profit, move on. So you buy one property. It takes a couple of years, 18 months to get built. You take your profit, sell it, take your $100,000, whatever it is, pay some capital gains tax, and then spend that money on whatever you want. Put it in your existing property portfolio, go to Europe, who cares? You've just got a bag of money to play with there. But you could take the original deposit that you put into the armchair property and poke that into another armchair project. 2 years later, sell that, take your money, go and do something else with it. Take the same deposit, the same original amount of money you put in the first one, that's now gone into the second one, take it out of the second one when you've sold it, and put it into another one. When it's complete, take your bag of money, go and do something, and so on and so forth down the track. So that's a possibility. Use the armchair developer concept just to create some cash for you every couple of years. Now, there's nothing wrong with that. It's quite an appealing scenario, to tell the truth. Don't have to worry about long-term capital growth. Don't have to worry about interest rates. Don't have to worry about tenants. Don't have to worry about all those little niggling problems that occur when you're holding long-term property as a landlord. So just buy and sell. Take the profit and run. What about Now, there is some considerations, tax issues, of course. You've got capital gains tax, there may be some GST components, and recycling the original deposit. The tax department may not see that as a tax deductible transfer, so you need to just check those things out, but it's certainly very, very doable. What about we accumulate the portfolio and just flog it? Right? Build it, say, after 5 years and then sell the lot, or hold it for 10 years and then sell the lot. These 4 properties bought over 5 years. What do they look like? Well, if you follow the maths through, if you see 2018 there, if you add up all the worth of those properties, after 5 years, it's just on $2.5 million. Or if you wait for 10 years, there's about 3.5. Now, there's a heap of debt in that. So if you look down to the bottom of the page there, it says the profit after 5 years minus the debts, which is $1.6 million, 4 properties at $400,000 each, and the capital gains exposure, you walk away with $741,000 in your pocket, which is not bad. I mean, that's not bad for 5 years' work, is it? That's a pretty good return. Alternatively, if you're prepared to keep them for 10 years, minus your debts, minus your capital gains tax, you'll walk away with about 1.5. So there's nothing wrong with that as a scenario. Buy them, hold them, sell the lot, pay your tax, walk away with a bucket of money. There's nothing wrong with that scenario. Alternatively, what about after 10 years, you don't sell them all. You sell the last 3, but keep the first one. So, if we look, and they're the growth rates, if you like, so the first column, the first column is the years, the first main column is the first property, then the second, the third, the fourth property, and you'll notice that the bottom line shows the value of all those 4 properties in 2023. Now, if you sell the last 3, pay the capital gains tax on them, you'd have $1 million, roughly, in your pocket. Take your $1 million, use $400,000 of that to repay the debt on the first property. So you now own the property outright, there's no debt, and your rent is about $40,000 a year. So that's not a bad scenario. You've got $680,000 in the bank earning interest. You've got $680,000. You've got property worth $1 million. There's no debt on it. You've got $684,000 in the bank, and you've got income of $40,000 a year. So that's not a bad scenario. What about this for the last one? Sell one property every few years. So if we looked at the years go by, if we go down to year 10, which is 2023, that property's worth $1 million. What if we sold it? Took the money, how long could we live on the funds that were generated before we had to sell the next one to generate more funds to supply our lifestyle? So if you want an income of $100,000 a year, it'll take 10 years according to the statistics we've done. So you bought a property, it cost you $400, it's worth $500, you wait 10 years, you sell it, it's grown in value of course, in fact it's worth just over $1 million, you sell the property, you pay your debt, you pay your capital gains tax, you've got nearly $500,000 in your kitty. Alright? So that'll allow you to live for the next 5 years on roughly $100,000 a year. Now, look, yes, I know, I haven't included in these figures the selling costs. It'll cost about $15,000 to sell the house if you use an agent. But I haven't also included in there that the $493,000 you put in the bank will be earning interest for you, nor have I included the rent return on the 3 properties that still remain in your portfolio. So that will be generating some sort of cash flow for you as well. So I think to be on more than $100,000 a year, but nevertheless, let's leave it at that. So 5 years go by, you've used up all the money, what do you do now? If you look at this next property, 5 years later, that second property you purchased, that's 14 years you've held it now, sell that, it's worth 1.3, sell the property for 1.3, your debt's 400, capital gains 181,000, the total in your pocket is 742, and that'll allow you to live for another 7 years on $100,000 a year and have 42,000 left over. Do it again, you can see how the process works. 7 years later, you take that original property, the third one now, you've held it for 19 years, according to that 7.2% capital gain growth rate, you'll be worth $2 million, you sell the property of course, and you'll end up with about 1.2 in your pocket. That'll give you 12 years on $100,000. Now you're now about 107 years old, and you've still got one more property left over. So if you do that, you sell that last one, 10 years later comes down the track, the property's worth about $3.8 million. Sell it. Do what you want. Or just go and buy a boat. Just spend the money. You've got $4 million and you're old. There you go. Do what you want. So there's a scenario for you. There's a range of scenarios for you. None of them rely upon the concept of borrowing against the equity, because that's no longer available. It's all about getting some capital growth, and you can accelerate the capital growth by using the armchair concept, which gives you a kickstart at 20%. You're already 20% underway when you take ownership. So in summary, guys, we must do something, I guess, to secure our futures. Perhaps the wages we receive, or the superannuation we generated, is insufficient to help us through, and property can be the way to go, or property can be a way to bolster and support an existing retirement scenario. Now, I use the word retirement, but it's about stopping work or being able to have sufficient funds to do what you want to do with your day. But we need to do something. Property is an appealing option in terms of generating income for us. Armchair, we believe, is a very, very good choice to get that process underway. And with property, there's a range of options for you that allow you to stop work, whether they be selling them or selling them down or living on the rent or some sort of mix match of all of that. And of course, the consequences are, if you don't do anything, what do? Work till you die? Live off the pension? Or hope the kids all become brain surgeons to support you in your retirement? Folks, thanks for that. I hope it's been of some use and perhaps stirred some thoughts in you. Derek, I'm sure, would have gone through at the very beginning the importance of working out how much you need to stop working, and I couldn't stress that more. Sit down, have a good think about how much money you need to stop in order to fund the lifestyle that you wish to lead. And if you know how much it is per week, then you know how much per month, and you know how much per year, and now you've got a target to work towards. And look, you may be much closer than you thought you were. So sit down at some stage and work out exactly what it is that you require to fund the lifestyle that you want to lead. And then work out, of course, how you're going to get there. But once you've got the target, then you're well underway to starting to achieve your goals. And feel free to call us at any time, folks. So you don't have to talk, of course, directly about what we've got on the market. We're happy to talk generally about property or about retirement vehicles or any aspects that we can help you with. More than happy to talk to you. And stay in touch with us, guys, because things do change. Opportunities leap up all the time. We haven't even begun to speak about commercial property. So please talk to us at any time if you have any questions. Folks, thanks for listening. Don't hesitate to contact us, and we're more than happy to help you with whatever we can. So enjoy yourselves. Thanks for now. Bye.